Hi, everyone, and welcome back to Wade and Wealth. Thanks again for joining us wherever you're listening or watching from. Hoping that you are warmer than the two of us are in this room. Broadcast Central's a little chilly this morning.
Big window in the room here.
After a significant snowfall this past weekend that has no doubt left us appreciating the warmer months.
First taste of winter. I mean, it's
been a while.
I hadn't gotten the snowblower out all season until this past weekend. So being the middle of January, that's a pretty good run.
Yeah, no, it's not bad. It's not bad, but
it made up for it.
Yeah.
I got a lot of snow.
Good sized snowfall, and you may have noticed markets have cooled off a little bit as well to start the year. And that's what we're going to talk about today. Why the stock market has come down, and some of the things that are happening. We're going to talk about inflation, interest rates, and how that is impacting things and what that means going forward.
It also means that our prediction before we started 2022 that the market would go up and down.
Correct again.
Accurate.
The streak continues.
Yep.
So one for the good guys there. And before we dive into this, just because I think sometimes we get an unreal expectation that the markets just go up.
Right.
Because some of the interactions I've had this week have been people genuinely surprised or really, really concerned that their accounts have dropped in value by what I would consider to be a very modest amount.
And in fairness to them, as human beings, it's easy to be lured into that thought process, especially when, the markets haven't had a negative year since 2018. And for the past 3 years, not counting 2022, obviously, not only were markets positive, but fairly significantly positive
double digits
along the way as well. So it's really easy to kind of get lulled into this idea that, markets only go up and my account only goes up. And so, as we talked about in our podcast last week, the fact that the pain of a dollar loss is far greater than the pleasure of a dollar made, we very much latch on to these, even though what we would look at it and say, those are modest swings or downturns in the account, it's easy to get a little nervous simply from the psychological aspect of being human beings.
Which we all are.
Mm-hmm.
And so,
Yep.
What's causing this? The Federal Reserve has announced plans to wind down their bond purchases of United States Treasury bills. This is what is called a taper.
Yeah, I would say that's the jargon term that you'll hear a lot on CNBC or capital market news stations as you watch them.
So let's start with a brief history lesson of what's been happening since basically the Great Recession back to 2008, 2009, a policy that is known as quantitative easing, which is what was used by the Federal Reserve to help stimulate growth in the economy and help the stock market recover. Very simply, the government is purchasing treasury bonds, which are also issued by the government. And in purchasing these treasury bonds, they are reducing the supply of them, which has caused the demand for these to increase. If there's fewer of something, if you're looking to buy basically anything right now, there's fewer of it. And therefore, the price has increased.
Yep.
What that has done with bonds, it has caused the prices of these bonds to rise, which has caused the interest, the yield, to drop. And that lower yield has therefore has had an impact on interest rates. So if you were looking to buy a home, cheaper to buy a home when interest rates are low, easier to borrow money, easier for businesses to borrow money, easier for money to be spent and allocated throughout the economy if interest rates are lower. That has been happening for a long time.
Yeah, I think we can use the analogy of someone who's very sick in the hospital that's on life support, which, let's face it, back in 2008, our economy was on life support. And you have to have measures in place to help sustain that life when the body or the human can't do it on their own. And so the Federal Reserve was pumping money into the system.
Got to admit, when you gave the example of someone on life support, I was wondering where this was going.
Well, but the reality
and it makes sense. It makes sense is that it needed, something had to be done to shift the tide. Right. And that's what happened. And I think, quite frankly, that this has gone on a lot longer than anybody ever anticipated it would.
Well, and the pandemic helped extend that
it did.
As well. Because
it did.
Back in March of 2020 or April of 2020, the Federal Reserve started buying more bonds again.
Right.
And when we talk about that, buying U.S. Treasury bills, why is that important? That's important because U.S. Treasury instruments, bonds, are the benchmark that every other interest rate in the universe is pretty much set off of.
Mm-hmm.
So when those interest rates come down, with the whole idea of let's get the economy on sounder footing, let's have people spend more money, whether it's a business or an individual, when mortgage rates or auto loans or home equity lines of credit come down, you're likely to help spur the economy, get people to spend more money. The same thing with bonds. Corporate bonds is a way for businesses to borrow money.
Yep.
When they can borrow money at a lower cost, which is the interest rate, they may hire more. They may engage in more acquisitions to grow their business, and that too helps spur the economy. But if we go back to the life support analogy, as the individual starts to get better and starts to get healthier, you have to start waning off of those. The hope is not that you have life support measures for the rest of that person's life. It's so that they can sustain it on their own. And our economy is getting to a point where it can start to sustain its own self. And we can't have these artificial measures to keep it going and propping it up.
And as with this hypothetical person on life support who has improved to the point where they want to wean off of that and be able to self-support, that is often with some pain.
Yep.
There is pain involved. There are new courses of treatment that are involved. There are large-scale changes that just because you're now out of the woods and you're not worried about perishing or passing away, there are still challenges ahead.
Right.
And so what's happening now is that, yes, the economy appears to be more stable. The stock market has done very well for a significant period of time. And so...
And we've seen personal wealth grow as meaningfully
substantially
as a result of that.
Yeah, substantially. One of the other things that we have seen grow is inflation.
Right.
And a lot of that has been pandemic driven. So the supply and demand created by the pandy has been, I had somebody say that the other day. I thought, I like that. By the pandy has really come to a point where I don't care what it is. I'm so sick of hearing, well, supply and demand is impacting this. It's impacting ketchup packets. It's impacting paint. It's impacting everything, to the point where inflation is now its highest point in 40 years. And that is one of the other big reasons why the Federal Reserve has said we are going to slow the purchases of bonds. They're not stopping. They're slowing them, because what needs to be focused on now is something else. And that something else is now getting inflation back in line.
Correct. And under control, because if that continues at the pace that it has, that's a real concern just for families.
For anything.
And anyone's pocketbook, when you're going and you're seeing these meaningful increases. I was talking to mom and dad over the weekend, and mom said, man, we're really, you really see prices rise at the grocery store. And part of that is there's been a fairly significant jump in those prices in a short period of time. But the other part kind of goes back to what we talked about in the beginning, is that we hadn't seen meaningful price increases for a long period of time at the grocery store. It was relatively flat or just up marginally. Whereas when you introduce, a significant increase to that, we feel that much more in a short period of time, when we've been lulled in the idea, well, prices don't really change that much until they do.
Right. Until they do. And they have substantially. Fill up your tank. I mean, that's a number that when I filled my gas up the last couple of times, I've looked and said, oh, geez.
Yeah.
Like that's a much bigger number than you're used to. And that's because gasoline is expensive, because groceries have risen in price. It's just across the board. And so because of that, the Federal Reserve is looking at this from the position of, well, maybe we don't need to keep interest rates as low now, because that seems to have corrected itself. We need to use, and often there is lingo or terminology that is used that can be confusing. And when Jerome Powell, the chairman of the Federal Reserve, came out and said, we plan to use our available tools to help stabilize prices, that means we want to help control inflation and help bring inflation within line, which the Federal Reserve has said its target is around 2%. And right now it's up around 6%, I think.
Correct.
It's pretty high.
Yep.
And so what that is essentially, it is jargon saying we want to focus on bringing inflation in line.
Right.
And that's not a bad thing.
No, because that's a direct impact to every American that's out there.
And so the question becomes, well, what do you do? And why is the stock market reacting so negatively? All the major indices are negative as we are recording this podcast on Tuesday, January 18th. They're all negative. So there has been across the board a response to this that has not been positive. Well, why is that?
Largely because there are other opportunities that are going to present themselves. If interest rates continue to rise, all of a sudden, fixed income and bonds are going to start to become a little bit more attractive to conservative investors. Because for the better part of the last handful of years, interest rates have been so low that to help cover your bills, you've had to look elsewhere in terms of investment opportunities to be able to get the same level of cash flow and dividends and interest that you at one point hoped to just get off of your conservative investments. So investors for the better part of the past 5 years probably have been forced to look at more stocks, more dividend-paying companies to help fill that gap that bonds haven't been able to provide. So all of a sudden, if interest rates continue to rise to the point where retirees are able to generate the interest they need to live from fixed income, they're going to take less risk and get that higher rate of interest along with it, which means that money would have to come out of stocks to some degree for that. That's a baseline.
Yep.
But the biggest part about it is uncertainty.
Yep. They don't like it. Markets don't like it.
Right.
They don't like uncertainty.
And inflation is a concern. The idea that, for a long period of time, the Federal Reserve was saying that inflation is transitory, meaning not a big deal. It's a short-term thing. And now all of a sudden, it's no longer transitory, and it's going to become a bigger issue and a bigger concern. The markets are concerned that perhaps the Federal Reserve was behind on helping to make some of these decisions, which means they may have to make some more drastic adjustments in the short term. But I think when we're talking about our clients, we always talk about the short term is going to do whatever it's going to do.
Yeah.
Our focus needs to be on the long term. So from a client's perspective, we get this volatility in the market. We see it go up and down, but what does it mean to their portfolio and their retirement?
Yeah. I want to backtrack for a second.
Please do.
Thank you very much. To say that when you talk about people moving money out of stock investments into fixed income investments, this is not right now necessarily individual people selling their stock investments and buying bonds. This is mutual funds that are seeing this happening and making large-scale sales of stock investments and purchases of bonds or preferred stocks or fixed income investments. This is pension funds that manage hundreds of millions, if not billions of dollars, making these changes because pension funds need to be they want to be as conservative as possible and generate as much income as possible. And so some of those that have been forced over the years to look at stock investments are now shifting back. It's not necessarily you and I and our clients that are causing this to happen. Large scale, what's referred to as institutional investors are often making these shifts. It's not panic across the board. It's people looking and saying, well, now maybe we can bring things in line a little more with what we would like.
And if it was panic, we would know much more about that.
Well, and if it were panic, it would be more severe.
Well, that's my point. I mean, we're talking about the markets. They're all negative, but they're all negative by a couple of percentage points with the exception of the technology index, which is a little bit more than that. But when we're talking about panic, you're going to see a much more severe downturn in reaction. And again, the market is always forward-looking. Those institutional investors they're trying to look and say, where's the market going to be in the next 3 months? Because that matters to them when they're kicking out their performance reports. For an individual or a couple in their retirement plan, the next 3 to 6 months are important, but you don't want to jeopardize your long-term goals.
No.
For the short-term volatility.
No. And there are a lot of decisions that you can make that 5, 10, 15, 20 years down the road, you can look at and say, well, this decision is responsible for a lot of what happened. Oftentimes, the best decision you can make is to be patient and not panic.
Right.
So what can you do? What should you do? I think, number one, this is a great time. We talked about this at the beginning of the year, and here comes the broken record alert. Take a look at your financial goals and your plan and your objective. Has anything changed?
And the reality is, if your circumstances or your goals haven't changed, assuming your investments were set up the way that they should have been in the first place, your portfolio probably doesn't need a change just because we've had a month or two of volatile and markets that have gone down.
Right. And that's why you have to sit back and look. And I would say even look at you can do this with investments too. We had Turney Duff on earlier this year or earlier in 2021, who was the author of the book The Buy Side, and talked about his time on Wall Street and how when people were panicking because Apple was down a couple of percentage points, he would go around asking, well, has anything changed with Apple? Right. No. Well, then why are you panicking? Mm-hmm. Has anything changed? And you can ask your advisor. I had this conversation this morning with someone. I said, well, things are down, but nothing's changed.
Right.
Has anything changed with Apple? Has anything changed with Microsoft? Has anything changed with the utility companies that you own because they pay quality dividends? Have you stopped paying your electric bill, or do you have plans to at some point in the near future? Not today. We're going to pay the electric bill better get paid with how cold it is in this room.
That's right.
So those are conversations to have with yourself or with an advisor or a spouse or someone that you trust.
And we have to remember that it's normal for markets to go down. Yeah. On average, a correction is what's called a 10% downturn in the stock market. They happen, every probably year and a half.
Every 18 to 19 months.
Yeah, and the last one we had was probably 18 or 19 months ago.
I believe it was 19 months ago.
Yeah, so these things happen. We can't get lulled into the idea that markets only go up. They don't. Over the long term, good quality stuff will work out just fine. Give you good opportunity for that. But we will have the ups and downs. It's normal. It's not normal for the market to just go up every single month. And so seeing these gyrations, seeing the when you get your monthly statements that your account will be down at periods of time, that's normal. It's to be expected. Often shouldn't be the driving reason for why you should go in and make adjustments to your plan or your investments as a whole.
One final thing to add: percentages instead of points. And what I mean by that is when you are looking at what has happened, the Dow Jones Industrial Average is the most widely quoted index for how the stock market did on a given day.
Right.
At one point today, it was down 550 points. Now, that's a big number. And you look and say, well, it's down 500 points. Then when I look to the left and see that's like 1.4%.
Right.
Percentages instead of points will always give you a better idea of what's happening.
Perspective.
And when you look at that, now, 20 years ago, a 500-point drop by the Dow when the
very
Dow
different.
Was 10,000 points or 8,000 points, very big deal.
Well,
much bigger deal than today.
That's 5 to 7%.
Right. On a day like today when the Dow is in the mid-30,000s, a 500-point drop, while still significant and while noticeable, 1.5%.
And as the Dow gets larger over time, which it has a very strong proven track record of doing that, those swings are only going to get bigger.
Right.
Because 1% on 100,000 is very different than 1% on 35,000. So the expectation should be those ups and downs will get bigger, but what won't change is that the news will always try to breed panic because they have advertising that they have to sell, and they're always going to focus on the point drop and not the percentage, which gives you good perspective of what's really going on.
Nobody's ever talking about all the planes that land.
That's right. Just the
Never
one that
hear
doesn't.
about the thousands of planes that land each day safely and without incident.
Yep.
Something goes wrong, you hear about it.
Every news station is right there at the airport.
Indeed. So, don't panic. Ask yourselves, what should I be doing right now? Review your investments, review your goals, and stay warm. If you're in the Northeast, it's cold here. We'll be back next week. Thanks for being with us on Wade into Wealth.